sure 99% of traders who trade order blocks have found yourself in a situation like this, when you have another block, then price comes all the way up, liquidate your order block, start going your way, and end up stopping you out. Well, I know this makes you doubt your strategy and how you trade. That's why I'm here to show you how to identify the correct order block and the most high probable order block. So in this video, you're going to be learning what is an order block, what is an imbalance, how to identify an imbalance, the future of an order block, applying order blocks to identify high quality setups. So without further ado, let's get into it. So what is an order block? An order block is a specific candle that represents a zone which illustrates supply and demand, where the banks are getting into the market, manipulating price, then causing a drastic move in the opposite direction. So whenever you see an impulsive move, like a lower high to make a lower low, we look for our order block at our lower high right here. Look for our order block at our lower high right here. That's on the downtrend. While on an uptrend, while on an uptrend, we look for the order block at the higher low that made this new higher high. So in an uptrend, this will be our order block. We draw them a whole full candle. We draw the full candle from the wick to the week to week. We don't draw body to body, week to week, because that's the full candle. So we look for our order block in an uptrend from an higher low that makes a new higher high. While on the downtrend, we look for our order block in a lower high that makes a new lower low. Okay. Okay, so in order for us to understand why order blocks work the way they work and why they cause the move they cause, we need to understand the first most important thing that helps us understand what an order block is, which is an imbalance. So this brings us to the question, what is an imbalance? So an imbalance is an area in the market which illustrates one type of collective order that is taking place at that particular time. So for example, a bearish imbalance would look something like this. So a bearish imbalance would look something like this. Like I said, an imbalance is an area which illustrates one type of collective order that is taking place at that time. For example, when the market is trending down, a bearish imbalance would look something like this, where you will see a space in the candle, without the wick filling it. That is this candle one right here, and candle two right here. There is a space there. This is what we call an imbalance. And this candle right here, there is a space here. This is what we call an imbalance. And the next candle that forms after it, we also maybe just leave a wick. Which will also which will now make this imbalance valid. So this is an example for a downtrend. This is an example for a downtrend. Same thing applies to an uptrend. Same thing applies to an uptrend. When the market is trending up, you will see spaces within candle 1, 2, 3. There will be space in between. There will be space at candle 2, and the wick of candle 3 doesn't cover the body of candle 2. Hope you understand. So what that gap is telling us is that at that point in time in the market, there's only one collective order taking place. That means at this point in time, when this market is trending down, it's only sellers that are in the market. There are no active buyers, or the buyers in the market are little, which are causing these little pullbacks. Because these little wicks you are seeing on the lower time frame is a pullback. So at that point in time in the market, there are much more active sellers than buyers. Okay, same thing applies in an uptrend. Let me look at this. Okay, so same thing applies in an uptrend. As you can see here, in an uptrend, candle 1 left a wick. Then at the opening of candle 2, price continue buying, buying, buying. Price close right here. Price open candle 3. You can see that the wick of candle 3 didn't fill the body of candle 2, so thereby leaving inefficiency. What this is telling us that at this point in time in the market, there are only buyers in the market and fewer, let's just say, low sellers. There are not that much of sellers in the market, just buyers in the market. So sometime in the future, price has to come back down, fill this inefficiency right here. That's feed it till the top of candle 2, and also maybe come back down and fill it to the top of candle 1, here before resuming the main buy trend. Okay, so let's dive deeper so I can explain better. Let me explain better. Let's go deeper. Okay. Okay. So like I said, imbalances are 3 candle pattern formation that leaves a gap behind. That's just the simple basic definition of an imbalance. No need to complicate things. Okay. Where candle 2, where we have some kind of engulfing in candle 2, but doesn't have to be a perfect engulfing. It doesn't have to be a perfect engulfing. It can be like this. It can be something like this. I have something like this for candle 2. It's not perfect, but you can have something like this for candle 2. The engulfing doesn't have to be perfect. It doesn't have to be a big candle like this. As long as this inefficiency is right here, we know that price has to fill out all inefficiency before continuing the main trend. That's if we're in a bearish trend, price has to fill this inefficiency to continue the main trend. Okay, candle 1 also doesn't have to be a big candle like this, and it doesn't have to be bearish. It can be a bullish candle. It doesn't have to be bearish. It can be a bullish candle. You get? It doesn't have to be bearish. It can be a bullish candle. It doesn't have to be a perfect size candle. It doesn't have to be a big candle. You get? All what matters is that inefficiency that is lying there that price has to fill in order for us to continue the main trend. Same thing applies in the bullish market. We have our candle 1, candle 2, candle 3, which I said a 3 candlestick pattern formation that forms in the market. Okay, where candle 2 leaves a huge gap behind for price to later come and fill. So one thing you need to take note is sometimes price might come back down, fill part of the imbalance, and you see price start reversing. This doesn't mean that this imbalance has been filled. It doesn't mean that this imbalance has been filled. What this simply means is part of this imbalance has been filled, but there is still inefficiency below. You just fill part of it. So what you can see expect later is the price to come down again and then fill it to this tip of candle 1 before now continuing the main trend. So when this happens, this then tells us that the imbalance has been totally filled. The price is now efficient. Everything happening here is efficient price movement. You get? Okay. So take notes, the candles doesn't have to be perfect. It doesn't have to be a big size candle. It might be something like this. And it doesn't have to be bullish. It doesn't have to be green candles, all green, all red. You can see red candle here, and you see green. You get? So it can be a bearish candle, then a bullish candle, and another bullish candle. Still valid as an imbalance. You can see it in a downtrend. It can be a bullish candle, then a bearish candle, and another bearish candle. Is still valid as an imbalance. What matter is that gap that it leaves behind that has to be filled. Okay, what that is telling us is there's inefficiency in price, and price needs to be efficient in order for it to move smoothly. In order for price to move correctly, price needs to be efficient. So let's head into the charts and try and spot some examples. Right, so let's head over in the charts. Okay, like I said, a 3 candlestick formation. Here's our candle 1. This is our candle 1 right here. This is our candle 2. And this is our candle 3. This is our candle 3 right here. This is our candle 3 right here. As you can see, the bottom wick of candle 1 and the top wick of candle 3, they are not touching, as you can see. So this gap that is left right here is inefficiency. This is an imbalance or inefficiency. What this is telling us is at this time of price in markets, there's only sellers in the market. You can see these 3 huge candles, so they're only active sellers in the market. So you can see this right here also. You can see this is filled, so this is not an imbalance. So at this time right here, there's efficient price movement. At this time right here, there's efficient price movement. Here also, this candle here and this candle right here, you can see when I said price might fill part of the imbalance. So this was the 3 candlestick. Let's assume this was our 3 candlestick formation. This was our candle 1, candle 2, and our candle 3, and we're anticipating price to fill candle 2, this inefficiency. As you can see, price can come and fill part of it. That doesn't mean the imbalance has been filled completely. There's still inefficiency right here that price still has to fill sometime in the future. As you can see here again, another 3 candlestick formation. Our inefficiency is right here. As you can see this, major inefficiency right here. This was a major inefficiency right here. This was the candle free. Then what happened? Price started moving up to correct this move, but didn't fill the imbalance completely. So we still have inefficiency that has to be filled right here. So all this is just for a bearish trend. Doesn't matter the time frame, there are imbalances everywhere. There are imbalances everywhere in the market. But one thing you should know is you should stick to is following your higher time frame. Get like this imbalance now. What's this? Okay. Okay, like I said, there are inefficiency everywhere in the market. There are inefficiencies everywhere in the market. Like this. As you can see, this is the 4 hour. You can see this inefficiency here. All the only inefficiency that matter actually is your higher time frame inefficiency. As you can see this now, this inefficiency here, if we go to let's say our 8 hour, you'll see that that inefficiency doesn't isn't there. Or if you go to the daily, this might just be as we went to the daily, you see it's just two candles, there's no inefficiency there. So what you should focus on is the major inefficiencies. As this, just focus on your major inefficiency. This right here also, this was an inefficiency. Focus on your major inefficiency or imbalance. Okay, there are inefficiencies everywhere in the market. Every time frame you go to, you will meet an imbalance there. So let's check out for an uptrend. As you can see, inefficiency right here. This was the main three candlestick 1, 2, 3. So it's an inefficiency here. Price filled it all to this place, but it doesn't mean it was filled completely. This also was an inefficiency 1, 2, 3. Three candlestick. This was an inefficiency. This right here is an inefficiency also. This right here is an inefficiency. Three candlestick. Just look for where there are gaps. Okay. This right here is an inefficiency. As you can see, price filled this inefficiency completely. This one was filled completely. As you can see, this right here is an inefficiency. So first this three candle 1, 2, 3, but this candle came and filled it. So this right here is an inefficiency. All these lower time frame inefficiency don't matter because they don't matter that much because in the higher time frame price might be efficient. The higher time frame price might be efficient, or it might just be one major inefficiency. As you can see in lower time frame, it's showing two inefficiencies, but on your higher time frame, it's just one big major inefficiency. One thing you need to note is price will not always come back immediately to fill an imbalance. Okay, price will not always come back immediately to fill an imbalance, but price will fill it later. Just like as you can see here, after all the buy, when price started selling, you see it filled all this inefficiency, filled all this inefficiency it left, filled all those major inefficiencies were filled. Okay, filled all the inefficiencies were filled. So just focus on the higher time frame inefficiency. Okay, so let's get back to order blocks. Let's get back to order blocks. Okay, now before we start identifying order blocks, we need to know the 4 key features of an order block. That's the 4 key things that makes an order block valid. We need to know them. Okay. Right. So the 4 key features that validates an order block is number one, an order block must take out some form of liquidity before reversing price. That means it must take out some form of sellers in a bullish trend or a bullish market and buyers in a bearish trend. Okay, so let me write it down here. Number one, must take out some form of liquidity before reversing price. Okay. Number two, the second most important, a block must have imbalance after taking out liquidity. It must have an imbalance after taking out liquidity. Okay. Must have an imbalance after taking out liquidity. The third most important thing, must cause a break of structure or momentum shifts. Okay, must cause a break of structure or momentum shifts. Must cause a break of structure or momentum shifts. Okay, and last but not least, the fourth most important thing, now validate another block. Prior to another block being mitigated, there must be some form of liquidity lying before the other block. Okay, there must be some form of liquidity lying before the other block before it is mitigated. That also validates another block. Okay, so there must be some form of liquidity prior to the other block being mitigated. Okay, right. So let's start again. Let me explain again. Let me clear this. I don't think we need this anymore. All right. All right. So number one, an order block must take out some form of liquidity before reversing price. Okay. So what does that mean? What does that simply mean? It means what it simply means is another block must sweep and high, or must take out some form of liquidity before it reverse price. Okay. So let us dive deeper. So this was our lower low, this was our lower high, this was our lower low, this was our lower high, and this was the new lower low. So when I say it must sweep liquidity, it must sweep maybe an internal high, an internal structure high, or it can be a candlestick sweep. Okay, maybe the sweep of maybe the sweep of the previous candlestick high. Okay, so this is our lower low, lower high, lower low, lower high, lower low. So as you can see here, this high here was swept. This high here was swept. This high here was swept. There is an order block somewhere here, maybe on a much more lower time frame, on a fractal time frame. There's another block here. So when I say another block must sweep liquidity, I'm talking about an high being swept, maybe an internal high. All this is liquidity, this is liquidity. So It can be an internal high or it can be a candlestick. It can be a candlestick high. It can be the previous high of a candlestick. So when I mean previous high of a candlestick, I'm talking about this. This let us say this was our order block here, but this is the correct order block right here. When I'm talking about a candlestick high sweep, I'm talking about something like this, where the order block candle, that's the main order block candle, the main order block candle high sweeps the previous candlestick's high. Okay. Let me. Okay. Like I said, this let us assume this was the main order block candle. The previous candle high must be swept. That's considered a liquidity sweep. Or maybe an internal structure. That's an internal structure that forms the main structure. High must be swept. That's also an liquidity sweep. You sweep every high or a low. Okay. So, but for this case, this was the liquidity sweep right here. Though this was a valid liquidity sweep, there must have been internal order flow. But for this was the liquidity sweep right here. As you can see, it swept this candle high. This candle high was swept. This candle high was swept, which then gives confirmation that okay, has met one of the checklists of being a valid order block. So let's assume that it hasn't mitigated it yet. It has given me confirmation that this is a valid order block because following order flow also. Okay. So the next thing, the next feature, it must have an imbalance after taking out liquidity. What does this mean? What it simply means is the order block must have an imbalance lying must have an imbalance lying after it. That is this imbalance right here. It must have an imbalance. It must have an imbalance lying after it. That's after taking out liquidity. It must have an imbalance. So the third feature or the third criteria to validate another block must cause a break of structure or momentum shift. So as you can see here, when the banks started reversing price here, you can see that it caused this structural break. That's this BOS right here. This BOS right here that gives us this new lower low. Okay, and see that it caused this BOS, this momentum shift right here. Here's the fourth criteria, the fourth and last criteria. Must see some form of liquidity prior to the other block, prior to the other block being mitigated. Okay, what that simply means is there must be some form of liquidity lying before the other block before it was mitigated. So where is our liquidity that's lying before the other block? You can see it here, this high. This is an internal structure high. Prior to it being mitigated, there must be liquidity lying before it. That's this internal structure high. Okay, let's take a look at it from the 1 hour time frame. If we look at it from the 1 hour time frame, it looks a lot more clearer. And see that this was a consider this was a lower low, lower high, lower low. Okay, so let's go back to the higher time frame. It's a little bit more clear. So this was the liquidity line before it, prior to the other block being mitigated. Now let us see what happened. Let us play price forward and see what happened. So we could see that price started reversing. As we are in the pullback, started pulling back, took out this liquidity, then mitigated our order block. Mitigated our order block. And what was our first target? Our first target was this low right here. Let us see how price played out. Okay, let us see how price played out. And see, let's take profit. I hope you guys are getting to understand it now. So the first thing, price must take out some form of liquidity before reversing price, which is this one. This is liquidity being swept. For this candle high being swept, that's also liquidity being swept. Okay, must have an imbalance lying, must have an imbalance after taking out the liquidity, must have an imbalance lying before the other block, which is this right here. Two. Okay. Number three, must cause a break of structure or momentum shift. That's the third most important thing. Okay. That's the third most important thing. And the fourth most important thing, which is probably the most important of them all, must have liquidity lying before it is mitigated. Must have liquidity lying before it is mitigated, which is this right here. Okay. Also, one more thing. Let me play price back. Okay. Let us assume let us assume price didn't give us this liquidity here. Price didn't give us that high that was here. You can see cases when the market can do like this, then start pulling back, then it can give you an high right here. This high, let's give it that block, then sell off. This high becomes the liquidity that is formed prior to mitigating the other block. That is if there's no liquidity lying, there's no liquidity to the left. That means there's no liquidity to the left. So just assume there's just a straight candle, a big impulsive move, and price started pulling back. This inside this high that it gives you here becomes the liquidity that it needs to take out the mitigate the other block so it continues the trend. Okay, so let me show you, let me draw it out. Why lower low, then price can do something like this to get the other block, sell off. Okay, so it looks something like this. This will be the other block, and this is your liquidity lying before it. It still follows other criteria. That is, it's short liquidity somewhere at the back here, has an imbalance here, break structure, and has liquidity lying before it. So sometimes you might see something like this. This might just be a big candle, a big ass candle. Might just be a big candle, then price starts within this substructure, this internal structure, prior to the other block being mitigated. Okay. So I hope you guys now understand what another block is, how to identify another block in a trend. Okay, I recently did a video. Check it out right there. telling you the strategy I trade and how I trade. Okay, please go check out the video. Please like, subscribe, and share. I'll see you in the next video. Thank you.